This meeting is being recorded.
Namaste. Starting today, we will be taking up study of technical analysis with the help of few charts and other available resources. Before going further, I would like to bring to your kind notice the importance of converting the data into chart. Let us see a data presented here. Here you will see the data of the Nifty 50, the popular index of National Stock Exchange of India, as presented by the data provider or the information available with the stock exchange website. Here it is first column is a ticker and another is date and time. Next is open, next is high, next is low, next is close, next is volume. Like this, the columns will appear and the data is seen like this. When we see with the naked eye, it would be very difficult for us to say whether the stock is likely to move up or move down, because as we mentioned earlier, the very objective of the investment is to make profit. Profit is made in two ways: one, buying at low and selling at high, or selling at high and buying again at low. So the difference between selling price and buying price is the profit. So to know whether the stock or the index is likely to move up or move down, we should know, or we should have something at our disposal which will enable us to determine the likely way or the path the stock or index will take. This is what is called as a trend. Trend is defined as the likely course of action or direction of move in which the subject may travel in the days to come. Here, our aim is to find, when we want to buy, whether the index or stock is likely to move up, or when we want to sell, whether the stock or index is likely to move down. For that, we need to convert this data into a pictorial form, which is popularly called as graph, because it is rightly and wisely said that a picture speaks 100 times louder than words or figures. That's why we convert this into a chart. So there are very many different types of charts, but we start with the basic charts first. And the basic one is, first one is called as a line chart. Line out of the above price fields, only close is taken and plotted on a graph paper. It is called as line only chart. Now you can see very easily, you can visualize very easily, from here to here stock went up or index went up. From here to here it went down, and again from here to here it went up, and again it came down, and it is going up. So we have to verify and see and presume and predict whether the stock would like to move up or move down. From here, it went down to some extent and again went up and went down. The area from which it went down and started moving up is called as a low. This is called as a low. And the area to which it went up from some point where from it went down is called as top. So there are successive tops: 1, 2, 3, 4, 5, 6, 7, like that, and successive lows: 1, 2, 3, 4, 5, 6, like that. So the different points are called as tops and lows. The importance of the same, how to interpret them, we will take up one by one at a later stage. Now the next important chart is called as bar chart. Here you can see the bars. The same graphic representation is done in the form of bar, which is popularly called as bar, which takes into consideration the four fields of the data, that is open, high, low, and close. You can see a small left tick here, which is open of the day, and you can see the right tick, which is close of the day, and the bar length is the highest point is high of the day, and low is the lowest day. And under this, we generally plot volume for the day to take further support, or which fortifies the price action. For the sake of fortifying the price action and to substantiate the price action, We will consider volume patterns also, which we will take up later. And when the open price is less than close price, uh, open price is less than close, then the bar will be in green, and when open is higher than close, bar is in red. You can see here, here it is the red bar. That means open is here at higher level, close is less than open. And again here when you come to see, this is in green, this is the open and this is the close. So close is more than open. When close is less than open, bar will be in red. When close is more than open, bar will be in green. And also one should carefully examine the distance between open and close. When you see here, the distance is good and more. When you see here, the distance is very little. So next day market was down. That way you have to take into consideration where it is opening, how it is opening, what is opening, and what is the length of the bar. When the length of the bar is more than previous day bar, it is called as outside bar. When the length of the bar is smaller than the previous bar, it is called as inside bar. Generally, inside bars and outside bars represent short-term trend reversals. So we have to keep in mind the length of the bar, where the open is, how the close is, is the close above the open or below the open, and what is the length and distance between open and close, and what is the volume associated with that. And like that, we have to interpret, and we will take up bar study and different formations as and when time comes. And the next important charting technique is called as candlesticks. This is the candlestick charting. It is also something similar, very similar to the bar chart, but there is some difference. There are certain patterns which are associated with the charting pattern, candlestick charts. This is called as this is between close and open price. This is called as body of the candle. When close is more than open, it is green. When close is less than open, it is in red. And it is called as upper shadow, the difference between high and close or open. And this is called as lower shadow, the difference between low and close or open. Here you can see that the difference between close and open are very small, and close is less than open. That is why there is a red candle, and the body is at the top of the candle, and the lower shadow is more, which is occurring after a good run, that is which indicates a trend reversal. And you can see subsequently how the market fell down. And later when it comes to this place, the candle body is more, which is an engulfing candle, which is long, and the upper shadow is small, but still when you compare to lower shadow, it is more, that is double. The distance between close and open is more because it is a green candle. The open is less than close, so open is here and close is here. The day low is very near to the open, and the day high is very close to the close of the day, which is a bullish sign. We will have different patterns and techniques coming together in candlesticks. We will be applying one by one when the when and at appropriate times. Due to time constraint imposed on the video length, I am closing this video at this juncture and will come up with another video within very short time. Thank you very much.